The market is entering the week under the influence of several overlapping forces, including geopolitical tensions, shifts in sector leadership, and a series of critical economic and corporate catalysts. One of the most significant drivers right now is the surge in oil prices, which has intensified concerns about the broader economic outlook. When oil prices move sharply higher, they act as a tax on the global economy, raising costs for transportation, manufacturing, and consumers. If this trend continues, it increases the probability that economic growth could weaken and potentially move closer to recessionary conditions. At the same time, the labor market has introduced additional uncertainty. The most recent jobs report released on Friday was notably weak, although the market reaction suggested that Wall Street largely dismissed the data for now. Even so, the report remains relevant because it adds another layer of concern to an already fragile macroeconomic environment. Despite these headlines, the most meaningful signals about market direction are not necessarily coming from the news itself, but from price action across different sectors of the market. A closer look at sector performance shows that the headline movement of the S&P 500 does not fully reflect what is happening beneath the surface. While many investors treat the S&P 500 as the primary indicator of market health, the index has recently been supported by a narrow set of defensive and commodity-related sectors. Over the past 3 months, the only sectors that have posted gains are basic materials, energy, industrials, consumer defensives, utilities, and real estate, with real estate rising roughly 3% during that period. Meanwhile, other major parts of the market, including healthcare, communication services, financials, technology, and consumer cyclicals, have declined between 2 and 6%. This divergence highlights the degree to which investors have been positioning portfolios for a potential economic slowdown. Defensive sectors and industries that benefit from higher commodity prices have been the primary drivers of market strength, while sectors typically associated with economic growth have struggled. In effect, the market has been trading as if a recession is already underway or imminent, even though the broader economic data has not definitively confirmed that scenario. This positioning creates a very important dynamic for the months ahead. If a recession does not materialize and geopolitical tensions begin to ease, the sectors that benefited most from recession expectations could face substantial selling pressure. Energy, basic materials, industrials, consumer defensives, and utilities have already experienced strong gains because investors crowded into these trades. If the assumptions behind those trades begin to weaken, for example, if oil transportation through the Strait of Hormuz resumes normally, or if the geopolitical situation stabilizes, capital could rapidly rotate out of those sectors. At the same time, sectors that have lagged, such as communication services, financials, technology, and consumer cyclicals, could begin to recover as investors reposition for a stronger economic outlook. In such a scenario, the headline index may not move dramatically in either direction because losses in one part of the market could be offset by gains in another. However, beneath the surface, the market could be undergoing a major structural rotation that significantly reshapes sector leadership. Early signs of this shift have already appeared in recent trading activity. During the past week, the sectors that led the market over the previous 3 months began to show relative weakness, while some of the lagging sectors started to stabilize or outperform. Technology, which had been under pressure for months, became the second best performing sector during the week, declining ONL4Y 0.42%. Communication services fell 1.87%, utilities declined roughly 2.5%, and consumer cyclicals dropped 2.62%. Even though several sectors still posted losses, the key observation is that the former leaders, particularly energy and other defensive areas, began underperforming relative to the sectors that had previously lagged. In other words, the biggest winners of the previous 3 months became the biggest losers during the past week. These types of shifts often represent the early stages of broader market rotations, where investors gradually unwind crowded trades and begin allocating capital towards sectors that offer more attractive long-term opportunities. Geopolitical developments remain an important variable shaping the near-term outlook. Recent statements attributed to Donald Trump claim that the United States has destroyed 2 Iranian Navy ships over the past 3 days. Iran has responded with aggressive rhetoric, warning that ships entering the Gulf could face attack and stating that any attempt by the United States to escort tankers through the region could result in those vessels being targeted. Iranian officials have also suggested that ships entering the Gulf could end up at the bottom of the waterway. These statements appear designed to keep oil prices elevated by discouraging tanker companies from operating in the region. However, the immediate issue is not necessarily the physical destruction of ships, but rather the difficulty of securing insurance coverage for cargo and vessels operating in a high-risk environment. Tanker companies transporting billions of dollars worth of oil cannot risk operating without insurance, and insurers are hesitant to underwrite such shipments when the threat of conflict remains high. To address this problem, the U.S. government has reportedly established a $20 billion facility intended to provide insurance support, although the process of underwriting policies and restoring normal shipping operations can take time. Energy markets have reacted strongly to these developments. Oil prices surged approximately 13% during regular trading on Friday, and the United States Oil Fund, USO, gained an additional 3.6% in after-hours trading. Since reaching lows in April 2025, USO has nearly doubled, reflecting the sharp rise in energy prices driven by supply concerns and geopolitical risk. Despite this surge, longer-term expectations in the oil market suggest that many participants still believe prices will eventually decline. The April 2026 West Texas Intermediate contract is currently trading around $91.27 per barrel, but options tied to the December 2026 contract imply prices closer to $65 per barrel. These longer-dated expectations reflect the hedging behavior of companies that rely heavily on energy inputs, such as airlines and cruise operators. Such companies often purchase options that allow them to buy oil at predetermined prices in the future to protect themselves from extreme spikes in fuel costs. The lower pricing for distant contracts suggests that many market participants expect current supply disruptions to eventually resolve. However, if those long-term expectations begin rising significantly, it would signal that markets believe elevated oil prices could persist, which would represent a more serious economic threat. In addition to geopolitical developments and energy markets, the upcoming corporate earnings calendar will play an important role in shaping market sentiment. Several companies across multiple sectors are scheduled to report results throughout the week. On Monday, Zim will report before the market opens, followed by Casey's and Hewlett-Packard Enterprise after the close. Tuesday will bring results from NEO, Kohl's, and BioNTech before the opening bell, while Oracle will report after the market closes. Oracle's report may be particularly important because the company is deeply connected to the artificial intelligence data center ecosystem. Recently, the market for credit default swaps tied to Oracle has expanded sharply, indicating that investors have been hedging against potential financial stress in the future. If Oracle reports strong earnings and demonstrates a stable balance sheet and income statement, it could significantly ease those concerns and stabilize sentiment within the broader technology sector. The remainder of the week also includes several notable reports. Wednesday will feature earnings from companies such as Serve and Campbell before the market opens, followed by UiPath, Netscope, Stitch Fix, and Bumble after the close. Thursday's schedule includes Dick's Sporting Goods, Lee Auto, Dollar General, and Sleep Number before the open, while Adobe, Rubrik, Centennial One, Ulta Beauty, and Service Titan will report after hours. Although some of these companies are smaller than major index components, their results could still influence investor sentiment in sectors such as retail, software, and consumer spending. At the same time, the economic calendar for the week is particularly dense, providing multiple insights into inflation, labor market conditions, and economic growth.